Welcome to vTalkInsight, Market Drivers Daily for February 26th, 2026. Today, the AI capex boom, a cautious turn in equity valuations, and a fresh round of geopolitical flashpoints are pulling markets in different directions. Nvidia's results, a derating in software, and renewed tension in the Middle East and around Cuba are all testing where risk capital wants to be deployed. Let us start with how the AI story itself is changing. The AI theme is still the main macro driver, but the narrative is shifting from a single Nvidia story to a complex ecosystem with more visible fault lines. Nvidia has delivered extraordinary data center growth, with revenues in that segment rising around 3/4 year-on-year and margins near the mid-70s. Yet the market's reaction has been surprisingly muted. That combination of strong fundamentals and cooler price action suggests investors now care less about headline beats and more about the durability and breadth of AI demand. Much of Nvidia's recent revenue surge still comes from a handful of hyperscalers building out AI infrastructure at record speed. Management points to data center revenues tracking ahead of ambitious long-term targets and guidance well above consensus, with demand for networking gear, in some cases more than tripling from a year ago. However, those same hyperscalers are now spending more on AI data centers than they generate in operating cash flow, increasingly leaning on debt, which is already being reflected in wider credit spreads. Earlier this year, simply being exposed to Nvidia's AI cycle was enough to fuel outsized equity gains, but that phase appears to be maturing. Some AI hardware and quantum names are still seeing sharp rallies. Yet several prominent software and platform companies tied to AI have reported strong usage metrics without corresponding top-line acceleration. Market commentary increasingly highlights a disconnect between booming chip sales and slower revenue progress in software, consulting, and broader enterprise adoption, which raises questions about near-term monetization. At the same time, the investment opportunity set around AI is widening beyond megacap U.S. tech. Large alternative managers are attributing a meaningful share of recent performance to private investments in AI leaders, while traditional asset managers and hedge funds are deploying AI tools to lift research productivity rather than cut headcount. Infrastructure enablers, from industrials and power systems to fiber network providers with long-haul and remote data center coverage, are also seeing stronger demand and more upfront payments as the AI build-out ripples through supply chains. There are still important constraints and risks around this AI cycle. Compute and memory bottlenecks remain a key governor of growth, with memory chip makers and high-bandwidth suppliers emerging as crucial choke points, while energy availability is starting to limit data center expansion and prompting pledges for self-supplied power. On top of that, some evidence suggests the market may have overestimated the speed of broad enterprise adoption because organizational change is lagging the technology. For multi-asset allocators, the watch points now include whether enterprise and consumer AI revenues inflect in the second half of the year, how far hyperscaler balance sheets can stretch, and whether energy and connectivity providers continue to capture a growing share of the AI economics as we move into the next phase. The second key story is valuation, particularly in technology and rate-sensitive assets, where the market is reappraising what it is willing to pay for AI exposure. Nvidia just delivered what some banks describe as one of the largest beat and raise combinations in chip history, with profit growth near the mid-90s, yet its stock reaction has ranged from muted to outright negative in parts of the session. That pattern, echoed across several big tech names, signals that high expectations are already embedded and that multiples may have limited room to expand without clear new growth drivers. The adjustment is even more visible in software and broader tech indices. Key software benchmarks have dropped sharply year to date, with some down roughly a quarter in just a couple of months, as investors question terminal growth rates in a world shifting from traditional licenses and recurring subscriptions toward consumption-based AI agent models. Companies that met or even beat earnings expectations including large SaaS and data platform providers, have still faced target cuts and weak price action, reinforcing a sense that the sector is considered guilty until proven otherwise. Valuation tension is not limited to listed equities. Private credit vehicles are trading at notable discounts to underlying asset values despite generally stable performance, reflecting concerns about transparency, liquidity, and significant exposure to software borrowers that could see pressure as AI competition intensifies. In parallel, parts of the asset management sector are drawing renewed takeover interest, with competing bids pushing up deal multiples and highlighting how quickly perceptions of value can change when strategic buyers step in. There's a counter-narrative arguing that the recent derating has created opportunity rather than signaling the end of the AI theme. Some analysts note that valuations in technology and communication services have moved back toward or even below historical averages adjusted for past turmoil, while several large platforms with strong AI roadmaps still show robust earnings and margin expansion. Individual names in design automation, enterprise software, and data infrastructure are cited as examples where fundamentals remain strong. AI-driven revenues are ramping, and yet share prices have lagged after earlier drawdowns. Looking ahead, performance is likely to depend less on owning broad themes and more on how specific companies convert AI narratives into cash flows. Markets are clearly shifting focus from valuation re-rating to earnings delivery, with high multiple names appearing more vulnerable if they fail to produce upside surprises, while areas like traditional industrials, healthcare distribution, and parts of energy are drawing attention for what are seen as more reasonable multiples and tangible AI tailwinds. Cross-asset, U.S. fixed income has recently outperformed equities, consistent with a mix of valuation adjustment and renewed demand for perceived safety, suggesting that portfolio construction debates will increasingly center on where the balance between growth potential and valuation risk now sits. Geopolitics remains the third major pillar for markets, and it is evolving from tariff headlines toward more acute security concerns. Earlier this week, the focus was on trade tools and tariff authorities, but the risk map now features escalating tensions in the Middle East, a violent incident involving a U.S.-linked boat off Cuba, and slow progress in efforts to stabilize the Russia-Ukraine conflict. This mix of flashpoints keeps a geopolitical risk premium embedded in several asset classes, even as individual price moves, particularly in oil, have been choppy. The U.S.-Iran relationship remains central for both energy and volatility. Nuclear talks continue with narrow negotiating ranges, while the U.S. adds new sanctions and expands its regional military footprint, and satellite imagery points to Iran reinforcing nuclear facilities. Analysts warn that any U.S. strike could trigger direct and forceful retaliation, with a non-trivial risk of temporary disruption in the Strait of Hormuz, a conduit for a significant share of global oil exports, which would amount to a classic supply-side shock. Despite those tail risks, oil price action is not one way. Brent has been supported at times by sanctions pressure and Middle East tensions. Yet U.S. crude has recently logged several consecutive daily declines as markets take some comfort from ongoing talks and signs of plentiful supply from sanctioned producers and softer demand in parts of Asia. This leaves a volatile outlook where a diplomatic breakthrough could drain the risk premium, but any miscalculation around Iran or regional infrastructure could quickly reverse the trend. Beyond Iran, other theaters are also influencing risk appetite and sector performance. In Europe, sanctions on Russia have slashed exports and pushed Moscow closer to China for trade and technology, while efforts to resolve the conflict through further rounds of talks remain inconclusive. Elsewhere, heightened U.S.-China tariff rhetoric, court rulings that reshape how emergency trade penalties can be used, and new defense and trade alignments, such as India deepening ties with Israel, all contribute to a sense that supply chains and security frameworks are being rewired rather than normalized. Markets are responding in familiar ways to this backdrop. The U.S. bond market has recently resumed its traditional safe haven role, with a flatter yield curve as risk-off episodes coincide with geopolitical headlines, while gold draws support both from Middle East anxiety and energy shock scenarios. At the same time, political timetables, including concerns about the domestic impact of an oil spike around key driving and election seasons in the U.S., may act as a partial brake on immediate military action, even as deployments continue. For macro and cross-asset strategies, the key watch points are progress or setbacks in U.S.-Iran and Russia-Ukraine diplomacy, any sign of shipping or energy infrastructure disruption, and whether current safe haven flows into bonds and gold intensify or fade as these geopolitical narratives evolve. To wrap up, the AI investment cycle is still powering ahead, but markets are no longer paying up for the story alone. Evidence of durable enterprise revenues, balance sheet discipline at hyperscalers, and the ability of enablers in energy and connectivity to capture value are becoming crucial differentiators. Valuations in tech and software are being recalibrated, pushing focus toward companies that can translate AI into visible earnings, while segments of industrials, energy, and even private credit are being repriced in different directions. Over all of this hangs a dense geopolitical backdrop where U.S.-Iran dynamics, Russia-Ukraine outcomes, and shifting U.S.-China trade tools keep the risk of an energy or supply-side shock firmly on the radar, supporting periodic flights to safety in bonds and gold. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.